Hey everyone, this is Andrew from Dividend Growth Masters, and today one topic that I really want to cover is Warren Buffett, specifically some of his larger dividend stock holdings. Warren Buffett is primarily known as a value investor, but he does own stocks that would traditionally be very good dividend investments. So I want to cover some of five of his larger holdings today. So let's get started. One of his largest holdings actually is Apple. No surprise. It's a very big percentage of his portfolio, over 15% of his portfolio. Um, the stock, as of May 2019, currently yields about 1.45%, PE ratio of 17.8x. But if you back out all the cash that they have on the balance sheet, you're trading more like a low teen earnings multiple. So it's a very very cheap stock by that metric. Market cap almost $1 trillion. So obviously you guys all know about Apple. They sell smartphones, they sell tablets, computers, and all sorts of things. The iPhone is pretty much Apple's biggest driver of growth, and it's accounted for over 60% of sales in the last year. Macs and iPads and other software and services are a lower part of their revenue mix. Obviously, software and services is an area that they're trying to grow, especially with some of the new services that they're adding. Warren Buffett first acquired a $1 billion stake in Apple in Q1 of 2016, and since then he's increased his position to well worth over $50 billion based on current market prices. So he's been pretty much almost all in on Apple ever since 2016, which is a little bit surprising since he's traditionally shied away from technology stocks. But in his view, Apple is more like a consumer products company now because their growth is pretty much dependent on the iPhone, and it has been for several quarters now. The iPhone is pretty much their biggest product in terms of sales and profits and future growth. So, what's to like about Apple from a dividend perspective? Well, it's a very recognizable brand. The brand is probably the most valuable thing about the company. Apple has billions of consumers all over the world, and they generate pretty stable cash flows. And they've grown tremendously over the past decade or so. And a lot of that, to be honest, is just from the adoption of smartphones. But consider this: they generated about 25 cents of free cash flow per share in 2005 and almost $13 in 2018. And they've consistently returned ROEs of over 30%. And they just started paying a dividend not too long ago. They haven't been paying a dividend for decades like some other traditional dividend companies, but they have a solid balance sheet with obviously a ton of cash. Okay, let's talk about another holding of Warren Buffett, and this is Kraft Heinz. Now, Kraft Heinz has been in the news lately. Obviously, the stock dropped significantly from February to now. It dropped, from $48 to worth trading now about $32, and a lot of that has to do with, I think, fundamental issues in the industry, and trying to merge two large companies like that. But it's right now, I don't think it's trading at too cheap of a multiple, and I wouldn't really consider it a value stock. Honestly, I would more treat it as, I would say, a turnaround merger story. But it does yield a pretty good dividend right now. But personally, I wouldn't consider it a traditional dividend company. So Kraft Heinz is one of Warren Buffett's larger holdings in his portfolio, publicly traded, that is. He does have much larger private holdings where he owns 100% of the business. So Kraft Heinz, they sell a variety of consumer products like condiments, sauces, cheeses, meals, meats, a lot of beverages, and a lot of other grocery products. So the company was formed after Heinz acquired Kraft in 2015. Both companies are big behemoths in the food industry. They've operated for over 100 years, and they own very, very big brands too. And Warren Buffett teamed up with a private equity firm to basically take over these companies. Obviously, the stock really hasn't worked out over the past few years. As you can see, it's gone from about $60 to $32, so pretty much cut in half over the past year. And because of the fundamental issues going on with the company, there's, I think, a big shift in consumer packaged goods in the grocery store channel. So I personally wouldn't be invested in this dividend stock. All right, let's talk about the third company in his portfolio that's a really big dividend stock, and that would be Wells Fargo, ticker symbol WFC. So the stock's done okay over the past year. It's down slightly. The good thing about Wells Fargo is it pays a pretty good dividend. They're paying about 3.7%, and they're trading at a pretty low valuation multiple. 10x earnings. They're a $220 billion market cap company. So Wells Fargo is one of the older banks and larger banks in the United States. They can be traced back to the 1850s, and Wells Fargo runs a lot of business lines, including banking, insurance, mortgage, investments, consumer financial services, lending, that sort of thing. It's one of the only large banks in the U.S. that doesn't have, traditional investment banking or trading arms, very big trading arms, like Goldman Sachs or J.P. Morgan, or Citigroup for that matter. So their primary focus is pretty much lending, and that's if you want exposure to that part of the industry, it's a good way to get it. Wells Fargo is one of Warren Buffett's larger bank holdings and accounts for more than 10% of his portfolio. And Warren Buffett actually began accumulating Wells Fargo shares in 1989, when there was a lot of pessimism around financial stocks, especially banks. So one of the reasons Warren Buffett likes Wells Fargo is because there's major cost advantages of being a very large bank like this. Alright, so the next stock that I want to talk about in his portfolio is Coca-Cola. Obviously, Coca-Cola really needs no introduction to any of you guys. They're one of the largest beverage companies in the world. So let's go over some of their stats first. They're trading at about a 3.8% yield. That's a pretty good yield, especially for a company of this size. They're trading close to their 52-week high. The valuation is a little bit high. They're trading at about 31 times earnings, and market cap is $208 billion. And the stock's done pretty well over the past year. Looks like it's been up from about $42 to $48 per share. So most people will think of Coca-Cola as just the Coca-Cola brand in terms of the beverage, but they actually own more than 500 brands, mostly in the beverage industry. And over 20 of their brands actually generate $1 billion in sales. And the good thing about Coca-Cola is it actually gives you a very large international exposure. So if that's something you want in your portfolio, this might be a good stock for you. Only about 20% of the company's volume is in North America. So there's a lot of volume that they're selling in Mexico, China, Brazil, and Japan. The Coca-Cola company might be Warren Buffett's one of his more famous stocks, because he bought a major stake in 1988 after the stock market crash in 1987. And at that time, I believe he was pretty good friends with the CEO of Coca-Cola. Now, the one thing I don't really like about Coca-Cola is that there's been a pretty big shift away from traditional sugary drinks. And, I know Coca-Cola's been investing in other alternatives, but the bread and butter of the business is pretty much still, sugary sodas. So there's been a shift away from that business. I don't think, it is, I think, a cyclical trend, but I don't think it's enough to warrant not investing in the company. The stock's done pretty well over the past year, and the dividend is pretty good, yielding over 3%, and they've been paying it for decades and decades, and the balance sheet is solid. Growth is a little bit slower than other traditional beverage companies, but I think it's still a pretty good dividend investment. Alright, so the next one we want to talk about is Bank of America. Bank of America is another large position in his portfolio. He's owned warrants on it for a while. The stock is currently yielding almost a 2% dividend, trading at a pretty low valuation, 11x earnings, and it's a large company too, $292 billion market cap. So Warren Buffett first became involved in Bank of America back in 2011. He purchased 5 billion shares of preferred stock, which were yielding 6%, and he received warrants to purchase another 700 million shares over the next 10 years. So his decision was basically inspired by the Fed, who boosted the common shares in Bank of America during the financial crisis. So it was a pretty good investment because not only did Warren Buffett have warrants to purchase the stock, but he was also receiving the dividends on the preferred shares, which were yielding 6%. And come to think of it, right now, 6% is actually pretty high these days. You have 10-year treasuries that aren't even yielding half that amount. So Warren Buffett is actually a pretty savvy, in my experience, pretty savvy financial investor in terms of investing in banks and financial service companies. So I think his Bank of America investment has been pretty good, and I think it'll be pretty good going into the future. So the final stock that I want to talk about today is American Express, AXP. So American Express is one of his larger financial holdings. It's about 8-9% of his portfolio. The dividend yield isn't as high as I would like. It's only about 1.3%, but it does trade at a pretty decent PE multiple, only 15x. This is about a $100 billion company. American Express is one of the older financial institutions in the United States. They were founded in 1850, and they're best known for their credit cards and travel services. Over $1 trillion were billed on Amex cards last year. So Warren Buffett has owned American Express for a long time. He started investing in the company in the 1960s during a scandal that they were going through, and he's owned the stock for longer than I've been alive. So he first purchased the shares during the salad oil scandal, which caused American Express to incur a lot of bad press and major debt on their books. And he invested during that time, and he's made a pretty decent return since then. So his fascination with American Express is likely due to its status as the credit card in the U.S. They offer very premium credit cards, primarily to very wealthy consumers or small business owners. and I actually do own an American Express card, primarily for travel purposes. They give you a lot of good points when you, as a sign-on bonus, if you spend a certain amount once you open a new card. The one thing I don't really like about American Express is they charge some of the higher fees in the industry in terms of the merchants that accept the card. So they charge much higher fees than their peers. And one thing I've noticed is a lot of vendors have started not taking American Express because of that, especially my own dentist. And there's been a lot of new consumer peer-to-peer financial products like Venmo and PayPal over the years that have taken a little bit of share from Amex. But overall, I think Amex is trading at a somewhat decent valuation. The dividend yield is a little bit low, but if you do want some financial exposure to your portfolio at a relatively low risk, I think it can have a place in your portfolio. So these are some of Warren Buffett's larger dividend holdings as of Q1 2019. If you enjoyed this video, please hit the like button or subscribe and get some of my other videos. And if you want to learn more about dividend investing or financial statement analysis, be sure to check out my website, dividendgrowthmasters.com, or check out some of my online courses. I'll see you guys next time.